Debt management is a reality that nearly all small business owners face. While debt can fuel growth, fund new projects, or help you expand your operations, it can also lead to financial strain if not managed carefully. The key to thriving with debt is knowing how to handle it strategically so that it works in your favor rather than against you. Effective debt management involves understanding when and how to take on debt, planning for repayment, and adjusting your financial strategies as your business evolves. In this video, we'll explore some of the best practices for managing debt, helping you make decisions that support the long-term health of your business. Understand the types of debt available. Different types of debt serve different business needs, and understanding these options is foundational to good debt management. For small business owners, debt typically falls into three main categories: short-term loans, long-term loans, and lines of credit. Short-term loans are often used to cover immediate needs, like paying suppliers or making payroll. They come with shorter repayment terms, typically 6 to 18 months, and often carry higher interest rates. Long-term loans are generally used for larger investments, like purchasing equipment or expanding operations, and have repayment terms of several years. These loans often come with lower interest rates but are more of a commitment. Lines of credit provide a more flexible approach, allowing you to borrow as needed up to a certain limit and only pay interest on the amount you use. Lines of credit are particularly helpful for managing cash flow, as they can cover temporary gaps between expenses and incoming revenue. Choosing the right type of debt is crucial, as it affects how much interest you'll pay, how quickly you'll need to repay, and how well the debt fits with your cash flow. Being strategic in your borrowing choices can reduce financial pressure and give you the tools to make debt work for you. Assess your debt capacity. One of the biggest mistakes small business owners make is taking on too much debt without considering their ability to repay it. Before you decide to take on any new debt, calculate your debt capacity, how much debt your business can realistically manage without disrupting operations or sacrificing profitability. This calculation should take into account your current cash flow, operating expenses, and revenue growth projections. A common measure for assessing debt capacity is the debt-to-income (DTI) ratio, which compares your monthly debt payments to your monthly income. For small businesses, a DTI ratio under 36% is generally considered manageable, but this can vary depending on your industry and business model. If you're already carrying debt, look at the ratio of your debt to equity, D/E ratio, as well. A high D/E ratio means your business is highly leveraged, which could be risky in economic downturns or slow sales periods. By understanding your debt capacity, you ensure that you're only taking on debt you can afford, keeping your business stable even in challenging times. Prioritize high-interest debt. Once you have multiple debts, it's essential to manage them in a way that minimizes interest costs. A common approach is to prioritize high-interest debt first, an approach known as the avalanche method. With this method, you make minimum payments on all your debts except the one with the highest interest rate. By focusing on this high-interest debt first, you reduce the overall amount of interest you'll pay in the long run, potentially freeing up funds sooner for reinvestment in your business. Another strategy is the snowball method, which prioritizes debts with the smallest balances first. While this doesn't reduce interest costs as efficiently, it can provide psychological wins, allowing you to feel accomplished as you knock out smaller debts one by one. Depending on your financial situation, either strategy can be effective, but the avalanche method generally offers greater savings. Set up a debt repayment plan. A structured repayment plan is the backbone of debt management. Instead of making payments haphazardly, a plan helps you stay organized, track your progress, and avoid missed payments that could hurt your credit score or lead to penalties. Start by listing each of your debts, including the lender, amount owed, interest rate, minimum payment, and due date. This simple step can provide clarity on the scope of your debt and highlight which debts should be prioritized. Once you've mapped out your debt obligations, determine a monthly repayment amount that fits within your cash flow. Ideally, this should cover at least the minimum payments on all debts, plus extra for the debt you're prioritizing. Many business owners find it helpful to automate these payments, ensuring they're never late and reducing the risk of penalties. Reviewing your plan every quarter also allows you to adjust it based on changes in your business, whether that's increased revenue or unexpected expenses. A structured approach not only keeps you on track, but also helps you manage your debt strategically. Separate personal and business finances. Mixing personal and business finances is a common trap that can lead to debt complications. When you use personal funds to cover business expenses or vice versa, it's easy to lose track of how much debt belongs to your business. This blurring of lines can complicate tax filings, lead to inaccurate financial records, and make it challenging to understand your true debt obligations. To avoid this, set up a dedicated business bank account and use it exclusively for business transactions. Having separate accounts also helps build your business's credit score, which is critical if you want to access larger loans or better interest rates in the future. Many small business owners start with a personal credit score, but building business credit allows you to establish a financial history tied to your company. This separation reinforces financial transparency and makes it easier to track your debt, budget effectively, and make informed decisions about future borrowing. Build an emergency fund. Unexpected expenses are part of running a business, and relying on debt to cover these costs can create a cycle of financial dependency. Building an emergency fund is one way to prevent this. Ideally, aim to set aside 3 to 6 months' worth of operating expenses. While saving this amount might seem daunting, especially for new businesses, even a small emergency fund can reduce the need to take on new debt in tough times. Start by setting aside a small percentage of your profits each month until you reach your savings goal. This fund can act as a buffer for unexpected expenses, slow sales periods, or economic downturns. By reducing the need for emergency debt, you maintain control over your finances and increase your business's resilience, giving you peace of mind and helping you focus on growth. Avoid overborrowing. While debt can help your business grow, too much of it can be risky. Overborrowing puts strain on cash flow, reduces profitability, and limits flexibility in times of financial hardship. Before taking on any new debt, carefully assess whether it's essential for your business's growth. Is it an investment that will generate revenue, or is it a temporary fix for a cash flow issue that could be solved another way? Ask yourself if there are ways to achieve the same goal without debt. Could you lease equipment instead of buying it? Could you consider crowdfunding or equity financing if appropriate for your business? Being disciplined about borrowing ensures that debt remains a tool for growth rather than a financial burden. Seek professional advice. Debt management can be complex, and sometimes seeking advice from a financial professional can make all the difference. An accountant or financial advisor who specializes in small businesses can help you assess your debt situation, build a repayment plan, and identify opportunities to improve cash flow. Professionals can also provide insights into tax strategies or refinancing options that you may not be aware of. Investing in expert advice might seem like an added expense, but it's often worth the cost, especially if it saves you from costly mistakes. An advisor can offer strategies that maximize your financial resources, ensuring that your debt is managed in a way that supports long-term growth. With professional guidance, you can make informed decisions that keep your business financially healthy. Debt management is a skill that every small business owner needs to master. By understanding your debt options, setting up a repayment plan, and keeping a close eye on cash flow, you can manage debt strategically and use it to fuel your business's success. The key to sustainable debt management is making informed decisions that align with your long-term goals, avoiding overborrowing, and knowing when to seek professional help.